thank you, Ikechukwu. I'm still expecting more people. Type yes in the chat box if you have ever wondered if the new tax rules could actually benefit your investment. Thank you very much, Sarah. Thank you. All right, so I guess we can move on. So yeah, this webinar is proudly brought to you by Afrinvest, your reliable investment partner, in collaboration with Creston Pedable, your trusted tax and advisory firm. And we are joined today by two distinguished experts. We have Mr. Kilian Kanoba from Creston Pedable, who will break down the tax policy changes, compliance requirements, and what individuals and businesses should prepare for in 2026. And we have Mr. Abiodun Kerikwe, representing Afrinvest, who will be taking us through the investment and capital market implications of the new tax laws. So right now, we'll have a brief introduction and opening remarks to set the tone for today's session. So please join me in welcoming Mr. Abiodun Kerikwe. Mr. Abiodun, you're welcome, sir.
Thank you very much, Iboko. I'm super excited to be here today. I hope all of our attendees will find the session very interesting. Thank you for the interesting background you also provided, Ibuku. I think that sort of helps set the tone and what to expect from the very highly experienced speakers we've put together for you today. Just to dive right into it, I have the pleasure or the honor to introduce to you our lead speaker on the subject matter in the person of Mr. Kilian Kanoba. Kilian is a fellow of the Institute of the Chartered Accountants of Nigeria. He's also a fellow of the Chartered Institute of Taxation of Nigeria, with over 2 decades of experience administering, providing tax advisory in Nigeria and across other tax jurisdictions. It brings on board very quality experience, and we're super excited to have him join us today for this conversation. So Kilian, I yield the floor to you. Good morning. Happy to have you here.
Good morning, Abiodun and Ibuku. It's definitely my pleasure to join the Afrinvest family today to render this public service to the investing public in Nigeria. And I'm hoping that we all find this session very useful to every participant and beyond.
Thank you.
Yeah, thank you very much. Everyone has control of the slides, so I'm going to have to rely on her to track my progress.
Yeah.
Yes.
So, good morning, ladies and gentlemen. It's our pleasure to be with you today. The topic for discussion is one that you will agree with me. It's something that is very apt. Something that a lot of Nigerians have been following keenly. The Tinubu administration, the President Bola Ahmed Tinubu administration, did not waste time in immediately commissioning the Tax and Fiscal Policy Committee, which is chaired by a very reputable name in the tax advisory space, in the person of Taiwo Ogundele, who has been working tirelessly to reform the Nigerian tax landscape. As we all know, a number of our tax laws have been there for quite a long time. Most of them inherited from the British, even though they had been subsequently modified. Effective, I think in 2020, we started seeing a lot of activity trying to amend these laws by the use of the Finance Act, which was being churned out almost on a yearly basis. That also created a little bit of confusion because it became difficult to track the changes that were going on. And people were clamoring that there is a need to do a wholesale review of the tax laws. And that's exactly what this administration set out to do via that committee. And the work of that committee, we've started seeing the fruits of that work, which has led to the enactment of 4 critical tax laws, one being the Nigerian Tax Act, secondly, the Nigerian Tax Administration Act, and you also have the Nigerian Joint Tax Board Act, as well as the Nigerian Revenue Service Act, which all these laws now coming together have kind of codified almost everything that has to do with taxation in Nigeria. So you don't need to go looking for different laws to interpret different transactions. Everything is now consolidated within the Nigerian Tax Act, while the process of administration of each of the taxes has also been codified in Nigerian Tax Administration Act. So in the course of this conversation, we will take a brief look at the tax that concerns investments, especially the Capital Gain Tax Act, not especially, specifically the Capital Gain Tax Act, which has generated a lot of conversation in the media space and in investment circles in the last, I would say, a couple of months, when the reality of the contents of the new laws started dawning on market participants and retail investors like you and I. So we will try to understand very succinctly what are the new provisions that affect the CGT, and then see how those are likely going to impact on investors. What are the investors saying? How can we plan in 2026 and going forward when that law takes effect to ensure that we do not suffer too much? And then, of course, how do we ensure that we comply and meet all the requirements so that we do not fall foul of the law? So in a brief, these are the aspects of my presentation before I will hand over the microphone to Abiodun and Ibukun. Yeah, so the Nigerian capital gain taxation in Nigeria has not, it's not a new thing, like I said. Most of it was inherited, but the CGT Act was first enacted in 1967, and it was mainly targeted at taxing capital gains, which is, there was a need to differentiate between your everyday income from incomes that you derive from transactions that are deemed to be of capital nature. And this law, since its promulgation in 1967, has been amended a couple of times, but it's the same law that we have retained all through the period until when I think after the civilian administration took power in 1999, when they decided to recodify all the laws into the laws of the Federation of Nigeria, when it tend to have a new face, but still basically the same content. So the Capital Gain Tax Act typically imposes tax on the gains that we derive from disposal of assets that are deemed to be chargeable assets. And the law is very clear on what those assets are. And for the purpose of this discussion, we have got shares, options, debts. So even when you sell a debt, when you transfer, when a debt factor, for example, buys a debt over and he subsequently sells it and derives more than he invested in it, the gain there is liable to capital gain tax, except of course where it is deemed that buying and selling of debt is part of the operations, not transactions of that company. Digital assets, taxation of digital assets was also introduced via the Finance Acts. And even when you buy and sell foreign currency, any gain that you make on it is also liable to Capital Gain Tax Act. Of course, you've got the issue of real estates, which is the one that was the main focus for so many years until the economy started modernizing and some of these other types of transactions were becoming commonplace. But there is also the issue of even when you sell something that you created, which means you did not really buy it, but you created it. Take, for example, when you sell your intellectual property to another person. You didn't buy the intellectual property. It's a creation of your intellect. When you now sell it over, when you sell the right to that property to somebody else, it is deemed as a capital gain tax transaction. Very interestingly is also the fact that even where the person who is paying you did not really acquire anything, okay, as long as he's paying you a lump sum to enable you give up something or to compensate you for giving up something, even though he does not acquire that thing, that is also deemed as a capital gain tax transaction. And a typical example is when an employer pays off an employee as a compensation for losing employment. That lump sum that the employer pays to the employee is deemed as a capital gains tax transaction. The employer does not take over the employment. It doesn't now own the employment, but the employee has received a capital sum. So that too is liable to capital gain tax. Same thing as insurance policy against injury. That is insurance policies that are not life related. So those are also liable to capital gain tax. Forfeiture of rights, like when the government takes over your land, for example, and they pay you a compensation. That is also a chargeable transaction under the Capital Gain Tax Act, and so many of them, as you can see there. So the critical point to note is that where a disposal is deemed to have occurred, okay, and that disposal is in respect of an asset that is deemed to be a chargeable asset, then capital gain tax will arise. So whether it's in respect of lease, transfer, assignment, or a compulsory acquisition, okay, a capital gain tax transaction has arisen. The Capital Gain Tax Act contains all the procedures for filing, and it actually made reference to procedures that have been spelled out in the Company Income Tax Act as to that those processes will be applicable to filing capital gain tax returns and all of that. I think the only difference that was made by the Finance Act was to say that capital gain tax returns will be filed twice a year, in June and in December. So transactions that happen between January and June are filed in June, and the ones that happen between July and December are filed in December. But all other processes regarding assessments, regarding of course disputes and objections and payments are supposed to be in line with the provisions in CETA. Just by way of a timeline, like I had pointed to earlier, the capital gain tax, CBT on capital market, which is our major reason for gathering here today, has experienced an evolution. In 1967, when the law was made, it was a blanket law until 1998. In 1998, it was amended to grant exemption to the tax on any gains that are derived from trading in listed securities, as well as in government securities, of course. This was maintained. And of course, you remember in 2012, and we are going to see a little bit of the impact of these changes. In 2012, you recall there was the tax exemption order that was signed by the by the Minister of Finance and coordinating minister for finance and economy during the time of, I think it was Ngozi Okonjo-Iweala at this point, under the leadership of President Goodluck Jonathan, where all gains, all profits derived from transactions in the capital market were totally exempted from tax, and this led to a big, an improvement in the markets. Recall that the markets probably. Can we move to the next slide, just so that we can see? Yeah. So you can see that in 1998. When capital gains tax was removed from transactions that happen in the capital market, you can see the impact it had on the markets. In fact, the market grew from in 2004. You can see that the market started growing, and in 2008, the market had reached a capitalization of about $108 billion. Okay, and this was the height of the market until in 2008, 2009, if we all recall, where there was a global economic crisis that led to the fall of the capital market across regions. Nigeria was not an exception, and that dampened activity in the market. So in order to reflate the market, government came up with that order in 2011-2012 to increase participation in the market and encourage people to begin to participate in the market again. And that arrested the fall of the capital market, because corporates were now willing to begin to invest again, and so you could see that it also led to the growth of the market, and the market started picking up. I think as at 2020, as at August this year, the market is deemed to have reached the $100 billion capitalization point again. This certainly would have been higher than this. The growth that you can see, the fact that the growth did not trend very sharply upward when the tax, the exemption to CGT was removed and all the other taxes, was mainly because, of course, the Naira started depreciating. And in dollar terms, the market also took a little bit of beating. So this demonstrates the fact that the capital gain tax and taxation generally has impacted on how the capital market has performed over the year. And recently, of course, we now have the introduction of the Nigerian Tax Reform Tax Acts, which include the NTA that I have mentioned earlier. And these laws, even though they have been promulgated as of June this year, will become effective in January 2026. And by that time, all the old laws that we know will lapse, including the CGT Act. So that now means that one of the key things, like we are going to see briefly, is the fact that because you no longer have a CGT Act, you now have a single tax rate, especially for companies. So it means that no matter the type of income that you are taxing, whether it's income from, whether it's profit or it's a gain, will not be liable to the same tax rates. And I think that rate can be anything between 25 and 30%. The government has promised that it's going to be 25% from 2026. But if the government does not issue that order to make the tax rate 25%, the law says that it should be 30%. Yeah. Can we move to the next slide? Next slide, yeah. So, I probably have spoken some of this. So, the CGT rates, as we all know, and as we have always known it, has been 10%, and it was typically computed on the gains that are derived from a disposal of chargeable assets, subject to the deduction of certain allowable expenses, which interestingly are not very much. The only expenses you can deduct from a capital gain tax computation are mainly expenses related to the purchase price. How much it costs you to acquire that asset in the first place, and then any expenses that you incur towards the sale of that asset. And in the case of shares, these expenses are usually not very much after deducting how much you paid. The only other expenses you probably pay will be maybe the stamp duty and the broker's commission and those things that normally come in the contract note. So that leaves you with a lot of gain sometimes that is liable to tax. And if you are not changing the tax rate, I'm not done, just go back. If you're not changing the tax rate from 10% to 20%, to 30%, it means that the tax that will be payable will jump. But another good thing, however, is that we are now allowed to consolidate our gains with our losses. So if you do some transactions and you make losses, those losses you can offset them from the gains that you made in another transaction. And so you will now pay tax only on the net gains, if you have any, as long as all those transactions happen within the same assessment year, which is usually 12 months, January to December. So that's an important point that we need to realize. The old capital gain tax did not allow that. You made a loss is a loss. You made a gain is taxable. But now, even before the new act commences, I think with one of the Finance Act of 2020 or 2021, I can't recall exactly now, they introduced the deduction of losses from capital gain transaction. Next slide now. Now, there is something that has been in the air, and this is very, especially with respect to people who are non-resident. So, a non-resident person ordinarily is liable to tax in Nigeria if he derives income from Nigeria. So, for a resident person, you are liable to tax in Nigeria because you are resident, and even on incomes that you derive from abroad, you are liable to tax on them in Nigeria. But for a non-resident person, he's liable to tax in Nigeria only on the incomes that he derived from Nigeria. And you will agree with me that some of the biggest volumes of transactions that happen in our capital market are transactions that are done by non-residents who typically are referred to as foreign portfolio investors. They bring in a lot of money to buy shares from the exchange. They also invest heavily even in our bonds and all the other instruments that are traded there. But of course, you also have even foreign direct investors who bring in money to invest in companies in Nigeria directly for a long time. So before now, some of those investments were typically structured in such a way that they are either investing through special purpose vehicles who are located offshore, just to ensure that, especially for foreign direct investors, they will typically invest through vehicles that are offshore, so that when they have to sell their interest in the company, they simply sell their shares in the offshore vehicles, and that transaction does not happen in Nigeria at all. And so there is no issue of capital gain tax on those transactions. For foreign portfolio investors, even though capital gain tax was reintroduced on sale of shares in Nigeria via the Finance Act, the implementation of that never really got off the blocks, because I think it has been a difficulty in determining how do you get non-resident people to file capital gain tax in Nigeria. How do you determine their gain and all of that? So that has really never really been very seriously implemented. So practically, it has had no implication. No impact on the market. But with the recent announcements, and coupled with the fact that the tax rate is going to be increasing from 10% to 30%, you see that a lot of a lot of this content has been in this capital market space among participants in the market. So, and it's mainly because for foreign investors, it's mainly because of two key provisions that have been introduced. One is in Section 46 of the Nigerian Tax Act. And like I recall that I said, if you derive gains from Nigeria, you are liable to tax. So even for foreign direct investors who are investing in Nigeria through special purpose vehicles that are not located in Nigeria, those special purpose vehicles, if their shares are traded, even though they are not located in Nigeria, can be deemed to be located in Nigeria. Okay, and it's very clear, if those special purpose vehicles companies are deriving up to 50% of their value from holding shares in a Nigerian company, then even though they are registered abroad, they are seen to be registered in Nigeria. So this used to be an avenue for easy exits from the Nigerian market by foreign direct investors. Now, this provision has ensured that even though you invest using that kind of structure, you cannot get out of the Nigerian market without paying tax in Nigeria. So the second provision there is that if you do a transaction, whether or not the value of the shares of the company you are transacting in derives 50% of value from Nigeria, but as long as that transaction leads to the change in the ownership structure of a Nigerian entity, okay, then it is deemed that that asset that you are trading in is located in Nigeria, and so it's liable to capital gain tax in Nigeria. So that's one. Section 47 also imposes CGT on non-residents who realize gains from the disposal of shares in a foreign company, where such disposals results in a change in the group membership of a Nigerian entity. So Section 46, Section 47, they tend to complement each other, and they have been drafted in such a way that as long as Nigeria is the target investment, any sale of shares in any company, whether or not that company is located in Nigeria, and that sale of share leads to a gain, and that sale of shares changes the structure of group membership of a Nigerian company, then automatically that transaction is seen as a transaction that happened in Nigeria, and so any gain on that transaction will be liable to capital gain tax in Nigeria. So that is one of the big issues that operators, foreign direct investors are having with the new laws that are coming into force in 2026. Now, as for foreign portfolio investors, their own concern is mainly with respect to, let me just mention that their big concern is mainly with respect to the fact that some investment came into Nigeria when the Naira was strong. And over the years, the Naira has lost a lot of value. Now, because those instruments are held in Naira, when they are sold, it gives the impression that a lot of gain has been made. Meanwhile, in dollar terms, there really was not any gain, probably even a loss. But because you are measuring the tax in Naira, you are going to realize a huge gain. And by the time you take 30% of that as tax, it's like, why did I come into the country in the first place? So this, for non-resident investors, it's a big issue. And that is why we have heard the kind of complaints that have pervaded the market in the last few months. So capital gain tax has really been a big instrument for government, really, as we have demonstrated. It has been used to control, let me not say control, it has been used to encourage the market severally by the government. And so we don't know whether the government thinks that the market has now reached maturity and it is time to harvest. But again, that's by the way. But that's a question that people cannot help to ask, especially when you are increasing the tax rates and still broadening the scope of people who will become liable to CGT under the new tax law. So it's been the law, the tax has played an important role, even though for at the state levels, they have used it to generate a lot of revenue, especially with respect to real estate transactions. But in the capital market, it's expected that with the level and the volume of transactions that happen there in Nigeria, that there's a lot of money, a lot of revenue that government will derive from it. But there's also the belief that Nigeria needs to reform its capital gain tax legislation to make it align with what is happening across a lot of countries in the region. Most countries typically do not have a different regime for taxing capital gain. Some do have, but the trend that we are seeing is a situation where countries are keeping their tax rates within the same level across whether it's capital transaction or income. And typically it is also to prevent people taking advantage of that and determining how to classify their transactions for the purpose of taking advantage of lower tax rates for CGT. So if you look at it clearly, one, government wants to modernize the tax system. Two, it wants to align with what is happening across the globe and across the region. And it also wants to ensure that it can boost its revenues from a market that is very, very active. Whether the steps that have been taken align with this vision, I think is left for us to decide. Next slide, please. Now, so let's look at what is the implication for individuals and institutional investors. I have we've talked very broadly about how it will impact on non-resident investors, but for individuals, for example, who are retail investors, usually many of us will not be caught because if your sale of shares is less than 150 million naira in a year, and you did not make any gain that is up to 10 million naira, you are not going to be liable to CGT. Okay, under the old law, the threshold was 100 million, but that threshold is being increased to 150 million. But take note that even where you do not derive proceeds of up to 150 million and your gain exceeds 10 million naira, you will still pay capital gain tax. So, like people who bought some certain shares that were going for less than 500 naira in December 2024, and those shares are probably priced at about 1,500 naira, and you had a good chunk of money put in those shares. If you make up to 10 million naira gain, even though you didn't sell up to 150 million, you will still have to pay capital gain tax. So we need to take note of that, whether you are a company or an individual. But one way to avoid capital gain tax is to reinvest your proceeds. So if you sell shares and you use the proceeds to buy shares in that same company or another company, you don't have to pay any tax, whether or not you made gain, irrespective of how much the proceed was. That automatically is exempted. Now, there are other exemptions with respect to sales in regulated securities lending transactions. One other complex transaction that is done by institutional investors. Those transactions are not deemed to be clear transfers as such, but temporary transactions, so they are not liable to CGT. Now, I have also already mentioned some of the criticism against the new CGT rules. First is the shift from 10% to 25 or 30%, whatever it is. Everybody believes that it's a big leap, and that will definitely impact on how people will want to invest from 2026 going forward. If you have to pay a tax that you were previously paying at 10, and which, like I said, was not even being paid at all, because the implementation had not really taken off properly, and then all of a sudden you have to pay 30% of that gain. People definitely will start looking at their portfolio and how to rearrange themselves. And I think that is why this conversation we are having today is quite apt. People also believe that this huge tax rate, of course, will erode the returns that is due to investors who had already planned for those returns. For venture capitalists who are investing for the long term and who are trying to help to create value in private companies, for example, they have been sending funds to invest in companies in Nigeria because of the good return that the market will give, given the fact that there is very low tax on what they will get eventually. Now they will begin to reprice those investments and need to think whether it's worth it after all. Possible negative impact on market confidence for foreign investors, that's very clear. And the big problem for foreign investors, like I said, is the fact that there's a double whammy. You have suffered a loss of value due to the depreciation of the value of the naira. And then again, now you are going to be taxed on a gain that is arising from that depreciation of the naira. So for them, it's a big issue. And so people are also thinking that this is affecting the competitiveness of Nigeria among other emerging markets. And so people will begin to think of where best to take their capital. And I think we saw a bit of that in the last couple of weeks, where the capitalization of the Nigerian stock of the Nigerian exchange was taking a beating. And I think it's as a result of that government has given assurance that they are taking a look at all this again. We know, I personally know that there is some work going on in that regard, and that government is going to issue rules very soon that will bring comfort to people with respect to CGT on capital gain tax. But until that happens, we just have to continue to work with what we have before us. So with all this that we have said, there is a need for us to look at how can you minimize CGT exposure. Yeah, you probably can just minimize. You may not be able to you cannot totally eliminate, consider the fact that if you have to play in the market, then you must take the pains that come with it. So it's about planning going forward, and I do note that some people already have started taking those steps to plan, and so we need to look at how you need to look at the kind of assets that you're investing in. We have said, certain assets are still exempted from CGT. Fixed income transactions like federal and state bonds and bonds that are issued by agencies of government are still exempted. And I think the current rate is not too bad that these bonds are given. Except, of course, by the time you may want to compare with the rate of inflation and all of that. I will leave that to Abiodun and the Afrinvest team to advise on. But it shows that those kind of investment gives you a clean gain and you don't have to worry about tax at all. So if it works with your risk appetite, you probably should be considering doing some of those investments. Then from an operational standpoint, you need to program your disposal. At what point do you exit, and how much should you exit for, in order to ensure that you keep yourself within the threshold where you don't have to pay capital gain tax. Third critical point is you need to time your disposal so that as an individual especially, your tax rates goes up with when you have high income. You don't have a single tax rate like companies. So you could time your disposal with to align with the periods where your tax rate is at its lowest possible, so that your CGT rate will also be within that rate. Another thing that you could also consider doing is to align your timing such that you are able to recover losses. So sometimes you need to take a look at your portfolio and say there are certain assets that you probably think you don't want to. You think we never do better than they are currently doing over time. And so you just want to just take your losses at that time. But it is, if you have such kind of asset, you need to sell those assets at the same time you are selling assets that will give you very good gain, so that way you are able to offset your losses from the good gains that you are making from the other asset, and that way you are able to pay a lower CGT rate. Yes. So for balanced growth and tax efficiency, an investor must regularly evaluate both the expected returns and the tax implication of each investment option. This will enable you to prioritize investments that deliver sustainable after-tax returns. Instead of focusing only on pre-tax profitability, you must also look at, after my tax payment, what will I be left with? Okay, so this is a time for people to begin to look at stocks, for example, that pay more dividend rather than stocks that give you appreciation. I'm not saying appreciation in value is not worth it. No, it's still worth it, but you probably should just begin to create that balance because dividends are exempted from any tax. They are frank investment income. You will have suffered the withholding tax of 10% after all. So I would rather that I will invest more in stocks that will appreciate in value but not very high, but that are also high dividend paying. You must integrate your tax planning into your investment strategy. For instance, by restructuring portfolio to include a mix of taxable and tax-exempt instruments. I've already mentioned that. And you need to determine at what point should you dispose so that you can deduct as much allowable deductions, including losses, as much as possible. So for individuals, yes, if you think that your tax rate is very high, consider buying stocks in the name of your family members who have a lower tax rate, so that if you have to pay, if you make huge gains, the tax on those gains will be at the lowest possible rate that aligns with the family members in whose name that you have bought those stocks. These are all very straightforward strategies that anybody could consider, but again, like they say, the devil is in the details. Next slide. Now, you may look at other instruments and sectors that offer tax advantages. I've talked about government bonds earlier, so I don't need to dwell on that again. But if you look at it from what is available out there, I think 2026 and beyond, we'll probably see a lot more people focusing on collective investment schemes and mutual funds, which are offered by companies like Afrinvest, mainly because the gains from these investments are not taxable at the fund level. So if the fund makes a gain, it doesn't get to pay any tax. It is only when it makes a distribution of that gain to the investors of the fund that it becomes taxable in their hands. And the law says that whatever is distributed to the investors in that fund should be treated as if it was a dividend, which means it is taxable at 10%. Now, that means that the fund is able to avoid the capital gain tax, which would have been as high as 30%, okay, because they don't have to pay any tax. So the net tax payable is kept within 10%, which it still would have been under the old regime, for example. So I think that this is a veritable vehicle that people should begin to consider in the new under the new tax regime. So next slide, please. Yeah. So how do we prepare to comply? Because the new tax regime also has a lot of punitive provisions which nobody wants to fall of. But again, if you are filing a return for CGT, you must ensure that all your deductions can be proved. If you say that you bought a stock at 500 naira and now you are selling it at 550 naira, you should have enough document to show how much, when you bought it. So simple documents like your contract notes that will typically not maintain or keep, this is the time that you must ensure that you keep them. If it's for a real estate asset, for example, and you incur costs to improve the asset, and those costs can be capitalized, you also need to keep records of them. And how much did you sell? You have to have evidence of how much you sell. If you did reinvest the proceeds, also have evidence that you reinvested the proceeds, and so you should not pay any tax. Don't forget, government is going to be tracking your banking transactions. So they will see all monies that are coming into your account from disposal of shares. But they will not really help you to prove how you expended that money. So the onus is on you to ensure you maintain documentation. You must also now, based on those documentation, include the gains that you have made and self-declare them in your tax returns. Don't wait for the tax man to be the one to determine those gains for you. It's always safer that you are upfront with them and you include them in your tax returns. Same thing for companies. What are the common pitfalls? Common pitfalls for taxpayers with respect to CGT is derived from this same thing. One, you don't have proof of your costs, and so you are not left you are not given the power of discretion to the taxman to determine what that cost is. He will not give you a favorable number. He will use the one that favors him, that will maximize tax collection. Miscalculation of taxable gains as exempt income. Don't misclassify. No, you need to be able to know what is taxable and what is not taxable. Omission of indirect asset transfers or digital asset disposal, thinking that government cannot track it. You'll be surprised how much information that they can actually lay their hands on. It's just a matter of time. And of course, late remittance of tax. Why wait until you are asked? Why not pay it and pay it at the current rate rather than having to pay penalty and interest on it subsequently? Next slide. Yeah, so for those of us who are professionals, I think we depend. Again, you can't be a professional in everything. You need to know exactly what you need to do. So at this point, everybody who plays in the market need the guidance of a professional tax and a professional financial advisor, so that they can be guided appropriately, especially with respect to how to interpret the law, so that you are able to comply. How do you plan strategically to ensure that your investments are properly allocated within your investment portfolio is balanced, you bearing the tax implication on the subsequent disposal of those assets in mind. That's critical. And of course, how do you manage your risk in terms of exposure to penalties and interest by the tax authorities? And for institutional investors, you want to be careful not to cause a damage to your reputation and seen as a non-compliant organization. Thank you very much for listening. And I'll just close to say that one key takeaway is the Nigerian Tax Act replacing the CGT Act, and it takes effect from 2026 January. Tax rates are being increased. It's broadening the scope of who is liable and what is liable. We have to plan strategically, both as individuals and as companies, on how to allocate our assets, how to time our disposals, and how to reinvest what we make. Tax efficient vehicle matter, like I've given examples. You may want to see how do you structure your investment. Do you want to use collective investment scheme and things like that? Keep your records and ensure compliance. Thank you for listening, and I hope you will have a few questions to ask after Abiodun has finished his own presentation. Thank you very much.
Thank you very much, Mr. Killian, for that insightful session. It was indeed an insightful session. One point that really stood out to me was how timing the disposal of assets. He said how timing the disposal of assets can significantly reduce capital gain tax exposure. It's a simple strategy, but it can make a big difference for both individual and institutional investors. So thank you, sir, once again. So building on that, we'll now hear from Mr. Abiodun Kerikwe, who is the Managing Director of Afrinvest Consulting Limited. He's a fellow of the Institute of Chartered Accountants of Nigeria. Also, he's an associate member of Chartered Institute for Securities and Investments UK, and a seasoned professional with over 20 years of experience in financial markets and investment advisory. So you'll be taking us through how to strategically position our portfolios in light of the new tax environment. So, Mr. Abiodun, thank you. We are welcome. Over to you.
Yeah, thank you very much, Iboko. Once again, glad to be here. So very quickly, diving into the focus of my section of the entire conversation, we've sort of broken it down into 4 parts, where we'll just look at generally how has the market reacted since the tax reforms announcement was made. And very well, we've seen that equities market sort of shrugged off initially the announcement when it was made early. Market continued to rally, supported by strong H1 numbers. H1 numbers here refers to half-year numbers. So if you look at the companies that are listed on the Nigerian Stock Exchange, the half-year financial performance as they release it to the public domain via the exchange portal, you see that most of those numbers were strong. And if you put into context where those companies were coming from a place where some of them had FX issues they were recovering from, they had losses they were recovering from. So most of those numbers were very strong. And to layer on top of that was a firmer macro backdrop, giving some of the policy reforms, both from the central bank and from the federal government, sort of cleaned up the macro environment, and the macro environment was much stronger. So that supported the market when those tax reform was earlier announced. But as the market began to digest that news, we saw that by late October, the market then began to pull back. If you look into the numbers, you see that for October as a whole, the NGX itself gained 8%. If you look at some of the sectors, for instance, if you look at the industrial sectors where you have some of the cement manufacturers, such as Dangote Cement, Boa Cement listed, that sector gained 17.5% in October. Oil and gas, where you have Seplat, Aradel, Total listed, that sector also gained 15.4% in October. So on the overall, October was kind of very positive for the market. But coming into the late part of October and now into November, we've seen that the market has really crawled back. Month to date, you're seeing the NGX index itself is down 6.8%. Some of those sectors that also delivered some decent returns in October have pretty much slowed down. You look at the insurance sector, for instance, is down 7.9%. Look at the banking index, also down 6.6% month to date. So that's just for the month of October. And that clearly just shows you that as the market began to digest the tax reforms, and as we got closer to year end, where the implementation is expected to take place or commence by January 2026, they then we saw a pullback in the market. But that's the equities market. If you look at the bonds market, however, the slide in front of you, you see there's a yellow trend line. That yellow trend line shows you the performance of the bond market, proxied by the FMDQ S&P bond index. You see that index continued to rally, not showing any form of reaction to the tax reforms news or the implementation of the tax law. So pretty much you can directly connect that with the fact that bonds market FGM bonds particularly is to be exempted. So bonds barely had flinched, and that, of course, that's backed by the FGN tax exemptions and the unwavering demand along the bond yield curve. This sort of then points you into the next slide, where we then see how the market is, how the different asset classes where the investors trade in the market is expectedly supposed to react or take an impact from the tax reform. So what we did was, and what we're showing you on this slide, is we created what we call a tax status score. That score moves from 0 all the way up to 3.5. So the higher the asset class goes towards 3.5, the more exposed that asset class is to the tax law. So if you look at it, along the 1.0 level, you have the FGN bonds, you have the Sukuk, you have treasury bills. Those guys, or that asset class, is totally exempted, hence it's not going to see any major impact. However, if you look at it on a risk-adjusted basis, so if you look at assets versus potential risk and return for those asset classes, you also realize that the higher the risk of an asset, which by fundamental traditional investing or portfolio management laws or teachings, the higher the risk of an asset, then expectedly the higher the return. So if you look towards the right end of the chart, you see there you find cryptocurrency. Already I saw someone ask on the chat, ask a question that would cryptocurrency also be included or also be liable to CGT? Yes, indeed, it is liable to CGT. And in fact, it's at the extreme right, which means it will take, it's not going to see any form of exemption, and will take the biggest hit from the tax law. And that's because it has the potential to deliver very, very superior or strong returns. So you clearly can see that. So in a summary, in a way, just to summarize, the tax landscape basically, it varies across different asset classes. Like I said, FGN bonds, Sukuk, T-bills, they remain largely tax exempt, while that also offers you some sort of efficiency around income. Instruments such as your mutual funds, fixed deposits, equities, and euro bonds, they would face withholding tax, while the income on those asset classes also would get charged by CGT when you dispose. Corporate bonds, real estate, and private equity and cryptocurrency pretty much sit fully in the tax bucket, which means they will see the most exposure to the tax law. And increasing tax exposure based on where those asset classes sit on this table determines how efficient you can optimize your portfolio. But before we go into the portfolio conversation, looking at how do I actually position my portfolio to take advantage of all of the reforms coming from Taxman, and then with all of the different variables that drives the investment climate, we sort of identified 6 key elements or variables that will shape the investment climate in 2026. Indeed, 2025 is winding down. Everybody now is looking forward to 2026. We sort of think lingering fiscal pressure is one of those key variables that could shape investment climate in 2026. If you're thinking about fiscal pressure, what you're asking, what do we mean by fiscal pressure? So that's all of the activities from the federal government, both in terms of their capacity to generate revenue via crude oil sales, tax revenue, and other channels where revenue can be generated. All of the strategy that needs to be done about government balance sheets. If you think about their borrowing, think about the cost of the borrowing, all of that sort of what we call fiscal pressure, and how that evolves would affect the investment climate in 2026. Sustained geopolitical risk, which again we've seen how that build up into 2025 and potentially is going to extend it to 2026. In the advanced economies, when you think about the US market, all of the global and advanced markets, low interest rates in those markets would also affect the investment climate in Nigeria in 2026. This 2026 is a year that should precede an election year in 2027. So with tradition, you see, or with history, you would have seen that there's always this sort of high pre-election liquidity that comes in just a year before election or into the election itself, just to drive all of the different electioneering activities. Again, there is the better equity valuation, which of course is critical as companies begin to report stronger numbers supported by better macro environment, improvements in consumption and demand patterns. All of that will translate into better equity valuation for companies that are listed on the NGX, and that's something critical for the market. Last on the list is low inflation. The low inflationary environment, which already we're beginning to see, would somewhat flow into 2026, and that again would influence interest rate direction, both from the CBN or the CBN Monetary Policy Committee, and of course the levels where debt or government will be looking to raise monies or debt to bridge budget deficit. This then creates that environment where you now want to begin to ask and think, where on the right side of it we have the new tax laws coming into effect in 2026, and on the left side of it you then have all of these variables I just identified that could affect the investment climate. You then ask yourself, how can I now position my portfolio? How should I strategize or rethink my portfolio to take advantage of the new tax laws coming into effect, and also take advantage of these variables that will shape the investment climate in 2026. So here we think like a portfolio manager, which is what we are at Afrinvest here. So we've identified for corporate investors, for retail investors, some broad portfolio recommendations which we believe if you can structure your portfolio, stick with the asset allocations that we're recommending, your portfolio will be positioned to efficiently optimize the tax law and also take advantage of those variables that will shape the investment climate in 2026. First of that portfolio is the one we call the tax exempt table income portfolio. I take that again, tax exempt table income portfolio. The objective of this portfolio is to boost after-tax returns by reducing exposure to taxable exposure to tax. And in terms of allocation, you then ask yourself, how do I allocate my funds across the different asset classes, which I had showed you earlier on a different slide, how those asset classes would perform on a risk-adjusted basis and also would perform based on the new tax law, right? So we think for this tax exempt table income portfolio, if you allocate as much as 60% to FGN state bonds, which you recall we agreed are tax exempt, you already are positioned your portfolio to shield it from CGT impact. Next is to allocate a 15% to money market instrument, another 10% to corporate bonds, investment grade corporate bonds, and another 10% to high dividend equities, a 5% to alternatives. Now, this would help you minimize tax yield through tax exemption, particularly using the 60% allocation to FGN bond. It will help you reduce exposure to 30% capital gain tax, then offer you very stable cash flows for budgeting and liquidity planning, and at the same time support balance sheet stability due to low volatility. Mind you, these are recommendations for corporate investors. The next portfolio recommendation is looking at corporate liquidity working capital portfolio. So here the mindset is, as a corporate, you need to ensure you maintain sufficient level of working capital that helps you meet your day-to-day activity, normal business activity. The objective is to preserve capital while minimizing tax drag for frequent disposals. Here the allocation would focus more on increased weight to money market, 55% to money market instrument, 10% to equity funds with low volatility and high dividend, 20% to government bonds, 10% corporate bonds, and another 5% to alternative. This will help you support short-term obligations due to high liquidity, low turnover, reducing taxable disposal events, and of course, it's suitable for corporates with fluctuating cash flows. If you look at the next slide here, we also identify two more portfolios that touches on how corporate investors will position for 2026. There is a balance sheet optimization tax loss harvesting portfolio. This will help you offset gains with losses to reduce 30% tax burden. The allocation is more weighted to core equities. Note that there is a bit of a distinction here. There is an allocation 40% to core equities, then another 10% to opportunistic equities. Now, this is the portfolio that is designed to help you use your losses to offset gains you make from the capital market before you're liable to CGT. So basically, you use your losses to reduce the CGT impact. So this portfolio is what's designed for that purpose. It allows you allows offsetting of gains with realized losses to reduce 30% tax burden, supports disciplined rebalancing, and of course, it provides a flexible framework for treasury and investment teams. On the next slide, we identify how retail investors can also position their portfolio. I believe most of our audience here today are mostly retail, so I'll spend a bit more time here highlighting how retail investors can position their portfolio to take advantage of the investment climate in 2026 and of course reduce exposure to CGT. First is the conservative individual. So as an individual, you're conservative. Here, a key characteristic for you here is you fall within the low tax bracket. The objective for you is to preserve capital, benefit from already low tax exposure. So here, the portfolio allocation is somewhat more balanced, where you are allocating 45% to FGM bonds that are already exempted from tax, another 25% to money market, which potentially could offer you a slightly higher returns compared to FGM bonds, but you are exposed to double withholding tax at 10%. Then when you sell, you also are exposed to CGT. Then there is a 15% balance funds, and of course 10% dividend stock. Dividend stocks helps you yielding or helps you generate dividend cash flow or cash flow from dividends, where what you are just exposed to is withholding tax. There's a 5% to real estate investment trust. Like I said, this offers you very stable, low risk opportunity to take advantage of the capital market, minimal exposure to chargeable gains events, tax exempt bonds, which strengthens after tax returns, and of course there is a balance fund which provides mild growth without high turnover. Then for those who fall within the moderate tax bracket, here they are described as the middle income individual. The objective for them will be to blend growth with income and tax efficiency. So they want to achieve growth. However, while achieving growth, they also need to generate income and maintain or achieve tax efficiency. Here, the allocation slightly shifts to a bit more into equities. Then, at 35% allocation, 30% allocation to government bonds that are tax exempt, another 20% to mutual funds, and 10% to money market and alternatives. This will pretty much help you to achieve balanced growth and income, reduce exposure to taxable gains, due to the fact that you've maintained a very diversified source. And of course, mutual funds allow tax efficient compounding of returns and gains, and is suitable across most market cycles. Then the last on this slide looks at the high income individual. The high income individual are those that will suffer, they are at the high end of the tax bracket, so they would suffer the most tax impact, or they are liable to pay the most taxes, which is the whole idea of one of the core principles of the tax reforms were saying that let the rich pay more taxes. So you are high income individual. The objective here is that you want to reduce your taxable, your exposure to taxable gains, right? So that the gains that are exposed to taxes are reduced as much as possible. The next objective is to shift to dividend and tax exempt flows. Now, the allocation that is sort of suitable for this kind of investors will be to focus on high yield dividend equities. So you want to allocate 40% of your portfolio to high yield equities, another 30% to government bonds, 15% to money market, 10% to equity income funds, or ETFs, and the 5% to real estate investment trust. What this does is it helps you to minimize your capital gains exposure, though there is a dividends that will be taxed at 10% withholding tax, and then of course you will still maintain strong focus on tax efficient income. Government bonds will provide you safety and predictability of cash flows, and of course returns. And lastly, the rates and would add inflation adjusted income to you. Although there is a bit of a minus, you'll be getting to your upside will be limited versus the potential of growth from equity. Dividend cuts can also impact income. So when companies decide to reduce dividend, it can also impact the cash flows you generate from dividend. And of course, concentration in income producing assets reduces diversifications. So the more you continue to concentrate in assets that will generate income, your ability to diversify your portfolio also reduces further. This leads us on to the last part of the recommendations for individual investors, where we identify that individual investor using collective investment schemes can also use that portfolio to achieve tax efficiency. The objective is that they will leverage collective investment scheme to achieve exemption and also lower 10% tax on distributions. Now, the allocation will be to put 40% of your funds into equity mutual funds, because they are equity biased mutual funds. Potentially it would generate higher returns. Then another 30% to bond mutual funds, a 20% to money market funds, and 10% to balance funds. So here the objective is the investor is investing primarily in collective investment schemes, which are mutual funds, equity, bonds, money market, and of course the balanced funds. What it does for you is income at fund level is tax exempt. So at the fund level, the income you're generating is tax exempt. Distributions taxed at only 10%. Then reinvested profits compound without immediate tax. Professional management, you also get to enjoy professional management, which of course reduces the risk of poor security selection. It's ideal for individuals with higher tax brackets also. And the last recommendation is for the very aggressive individual who could be classified as an high net worth individual, and at the same time they have the characteristics to be very active in terms of trading. They of course will use tax loss harvesting and diversification to manage rising tax liability. In terms of allocation, they will be more weighted to equity, core equity 40%, tactical equities 20%. Another 20% will be allocated to government bonds, and the 10% to money market and alternative or structured products, respectively. The advantage you get from this is that you get to earn high return potentially. Tactical bucket allows you to harvest losses to offset gains. So with the tactical 20% you allocate to the tactical equities, you use that to reduce or offset the gains you've made that would be subject to CGT. Government bonds would improve stability and of course suitable for sophisticated individuals with higher risk appetite. So these are the broad recommendations for retail investors for coming into 2026. I hope that you find this quite impactful and insightful. This brings us to the end of the presentation. We can take a couple of questions, so I'll hand over to Ibuku, our moderator.
All right. Thank you very much, Mr. Biodo, for that detailed and practical breakdown. I really liked how you showed the link between the new tax reforms and the actual movement we've seen in the financial markets. It really brings the conversation to life. You also helped us understand how tax drag can quietly eat into returns and the importance of structuring portfolios differently for corporate investors versus individual investors. And of course, those tailored recommendations give everyone something concrete to work with as we prepare for 2026. So it's been a great time so far. We've covered a lot. Now let's hear from you. At this point, open the floor for questions. So if you have something you want clarified, or you'd like either of our speakers to dive a bit deeper into a point, please drop your questions in the chat box to take them one after the other.
Already, Ibukun, there are a couple of questions in the chat box. There's one that says, for some of us that have invested via application, how will this affect us regarding the documentation and safekeeping of documents you mentioned? And joined late though, my apologies. Oh, that's very straightforward. So even if you're investing through an app, say for instance, the Afrinvest 2.0 app that allows you to trade equities, allows you to invest in treasury bills and commercial papers, or the Optimus 2.0 that allows you to invest in mutual funds, trade into the US market. All of this app have transaction history. They have a log. You can request, in fact, you can actually print the log at your end, or you request for the log to be printed and sent to you. So that helps you with the documentation. The next question here says, thanks for this webinar. My question is, will your fund manager send the tax receipt in the case of the 10% tax on mutual gains or mutual funds gains? No. So that question has jumped off. The next question here, how does Afrinvest or government know if I am making withdrawal from my wallet balance or from my proceeds, and at what point will the tax be deducted? Interesting question. I mean, maybe I will allow Kilian to take this question. It's a very interesting question, straightforward. I'll allow Kilian to respond to that because it's the mechanism for this is very embedded in one of the tax laws that was enacted?
Again, I think we need to understand one thing. The tax system is basically and first and foremost based on self-assessment, which means you are trusted to be upfront and make your declaration and file them. Where the tax authority deems it necessary, may call that you provide further information, or where the tax authority has information to dispute what you have filed, they may use the information that they have and raise additional assessment for you, which you can now begin to dispute. So it's important to know that first. Don't wait until you are caught. But very importantly, the availability of data by tax authorities. I mean, the access to data that is available by tax authorities, you'll be surprised how extensive that can be, how much data that they can access, including your banking data and all of that. So there is no stockbroker or fund manager that will give you money in cash. Eventually, that money has to go through your bank account. They would have carried out a KYC on you to be sure that that account belongs to you and all of that. So there's really no hiding place. It's either you are making it available or they find you out subsequently, and then you end up paying the tax that you avoided paying together with penalties and interest that come with it. That's just how we answer it.
Okay, just before you go, just one more question. How does CGT affect dividends from foreign-based mutual funds?
Yeah, so foreign-based mutual funds are, the law did not really differentiate between mutual funds or collective investment schemes, whether they are Nigerian or otherwise. But the treatment will still be the same. Any distributions from those funds to you in Nigeria will be deemed as if they are dividends. And the interesting thing with that is that if those dividends are received by you here in Nigeria through approved channels, they're actually exempted from any form of tax. So if those funds are coming in foreign currency to your account, you don't get to pay any tax on that at all. But if you do not bring them in, you just merely report them, then they are taxed the same way that any other income will be taxed, which means it will be taxed unlike local dividends, that if withholding tax has been taken at 10%, those ones will be taxed as normal income and at the maximum tax rates that is applicable to that individual.
Okay, thank you very much. Just one interesting question. We're closing right away, but before we close, I think this question is a bit tricky. It says, how do I receive the credit notes of 10% withholding tax deducted upfront by my broker or by Afrinvest and paid on my behalf when I invest in commercial papers? This will be required when I file my annual individual return. So I think it's kind of connected with one of the earlier questions I read asking about withholding taxes. Do they get receipts when those taxes are charged? I think it's just a similar question.
Yeah, so the way withholding tax works now, for individuals, for example, and even companies, it's expected that your tax identification number has been provided to your fund managers or your stockbrokers or whoever is managing your investment. So if you buy a commercial paper, if you buy into a commercial paper, then your details would have been obtained, and when the tax is deducted and paid to the tax authority, they use your tax number to remit that tax. Whether or not you get a credit, a receipt or a credit note for that tax, you can actually track it with the tax authority to see that that tax has been paid using your number. It is only when you don't get that credit that you should be calling the person that deducted that tax from you to clarify why you didn't get that credit. Credits are no longer, the receipts are not issued by the man who deducted. He deducts and he sends payment with a schedule to the tax authority, and the tax authority issues those credits, which should be communicated to you either via the platform, the tax platform, where you can check your withholding tax credits, but no paper credits have to be issued to you by Afrinvest, for example.
All right, thank you very much. This has been quite a very insightful session. Lots of questions coming in. Some of the questions are being responded to directly, so I believe all the questions are being answered. Sadly, we cannot take all of the questions because we've gone 2 minutes ahead of time. We're ending the session just here. But just before we end, we would like to thank our speakers, Kilian Kanoba. Thank you very much for the time and the insight provided. I believe it was well taken and quite impactful for the audience. Thank you also, Abiodun, for the insight provided around the recommendations. I believe I saw a question also, someone asking about which of the portfolio recommendations is most suitable for them. I can't find that question again right now, but I believe our people are responding to those questions one after the other. And if you still have more questions, kindly send them in via email. All our channels are open, both social media and of course email channel, research@afrinvest.com or consulting@afrinvest.com. Thank you, everyone. I think it's been a very beautiful day, and do enjoy the rest of the day. Oh, before I go, I'll hand over to Ibukun. She is the moderator. Ibukun, over to you.
Yeah, thank you.
Yeah.
Thank you, Abiodun. You've done justice to to that. All right. Thank you, everyone. Thank you, Mr. Kerikwe, Mr. Kilian, for the insights shared today. Thank you. We appreciate your time. And we hope today's session helps you navigate the new tax era with confidence. So yeah, enjoy the rest of your day. And from all of us here, thank you.